roughly 70% of the world's poor now live in countries that are middle-income countries. And so I think this, in some sense, needs to change how we think about where we are going to get redistribution from, where are we going to get economic activity from among the lower parts of the income distribution within a country. And to me, this is the context within which we need to be thinking about financial inclusion in countries like India today. Health shocks remain one of the most important reasons why households re-enter poverty once they escape it. And so I think, again, when we think about financial inclusion, we have to think about beyond things like banking access and much more about what is that set of financial instruments, be it insurance or others, that are going to get households out of it. If you look at public social protection spending as a fraction of GDP, this set of countries that I call high, poor, middle income countries, their spending on social protection is actually less than that of low income countries. And I think this is why, in particular, financial inclusion or financial access becomes particularly important in trying to think about how you can leverage some combination of technology, the private sector, and higher efficiency of welfare spendings to make up for, in some sense, what happened in the typical rich OECD country, which is just welfare spending really taking off around the income levels that these countries are at. A lot of the interest is in thinking about getting transfers to the poor in a way that is going to be target the right people and enable basic sustenance. And then I think there's the broader sense, which right now is sometimes a little bit lost in the excitement about welfare payments, but I think remains the bread and butter of financial inclusion, that if you're going to move people out of poverty sustainably, it's not going to be about a universal basic income. It's not going to be about $1.90 a day. It's going to be about some long-term ability to deal with shocks and to make the kind of human and financial capital investments that you need to make to enable a steady income. We never had that much manufacturing, right? So, I mean, if you look in the data, it's always been the case that entrepreneurship, especially for women, has been the key form of employment outside agriculture. And that, again, is something that clearly depends a lot on access to finance.
India witnessed its first brush with financial inclusion in 1969 with bank nationalization. What happened through a diktat was actually an attempt at getting the banking sector closer to the people. Now, why it did not succeed the way it ought to have, there are various reasons for it. Financial inclusion is not financial access. If you look at the rubric of financial development, financial access does not necessarily lead to financial inclusion. And I think the Indian experience bears it out very, very well. And by giving access through the nationalized banks to people, I don't think inclusion was achieved. And there are three other elements which are necessary for financial development. Unless you have the depth, unless you have efficiency. Efficiency is also related, to my mind, with technology. And the third element is stability in the system. So unless you have those elements in place, my fear is that whatever may be your desire for financial inclusion, it will stop at financial access and not result in financial inclusion.
I think we run right now the huge potential danger of doing for financial capital what we did for human capital for a number of years. So we say it's school enrollment or it's number of hospitals in a district, and now we're going to start counting it up by either if it's a bank branch, or if not a bank branch, do you have a PMJDY account? Access is not usage. I think a lot of the reason for the focus on access is not because anyone thinks access is financial inclusion, but it's the only thing they can measure. And so the reason why we measure PMJDY by number of accounts opened is because that's the only data that is easy to get. But I think we need to start recognizing that we want to be talking about impact of programs and projects, and then start leading much more of a discussion on how can we, while maintaining citizen confidentiality, actually start getting metrics that tell us about impact from administrative data. That thing I wanted to highlight, and I think this comes to the issue that a lot of the papers find somewhat mixed results. And I think that is, in some sense, a reflection is instruments will function very differently for different populations. So, the bank branch is going to have a very different effect for a middle-class individual, where it's probably going to be a great source of empowerment. Microfinance can have a lot of potential for a woman who has a very rare ability to actually get out and get a loan in her name. When you're thinking about financial inclusion, you're going to potentially have two very different sections of society with different needs. And it could be that we think of informal sources as bad for the poor, but the rich actually seem to prefer the informal sources just because they get the money when they want. How should we think about a role of regulatory instruments when you're trying to deal with some very different populations with very different needs for financial inclusion?
There are regulations for organized big financial institutions should be totally different from what you have for micro level, local level kind of institutions. And regulation should also create different structures for funding, financing the needy people. NBFCs, RBI has NBFC and the banking institution, same set of regulations, which they have more or less. Now you go down, you go to microfinance institution, there's a different set of regulations available for that. The light touch regulation of the MFIs probably did not go well with the market forces which were propelling these institutions to work and give yields and returns and those kind of things. So the interest rate shot up and the society got into the act and then said, how can you do this? So the regulation is not only from formal institutions, there is a societal regulation also coming into force. Now, something which we have not been able to really appreciate and take into account in our studies. Also creating more, structures or informal structures for funding is also required. We have got social groups which within themselves do the kind of lending which is required for the people in that particular group. We have communities which do that. Then there are some people who are in the local areas or money managers who take bulk loans and then distribute that money informally for people who require that short term, no documents, nothing. And the bulk money is received by them from the society or from institutions, and they're able to distribute it. What kind of regulation you will apply there? This is another issue which needs to be kind of looked into.
The current focus on JAM in India, I think this needs to be reviewed and assessed in a larger context of how it is playing out. And probably some more research needs to be done, because whatever little feedback that we in the media keep getting on the way JAM is working out, probably financial literacy is coming in the way of JAM becoming a success. So unless you improve upon this element of financial literacy and financial skilling, my sense is JAM, when you are linking Janadhan accounts with identity and mobile transactions, the financial literacy is going to be a very important element, and I don't think enough focus, enough stress has been laid on this element of this puzzle.
We talk about distribution of government benefits through the banks and directly go into bank accounts, but how does it actually go the last mile and reach a poor pensioner, particularly if you have to give up a couple of days' wages, or if you have to give up and pay for a bus ride to the nearest bank branch and draw it, as opposed to the postman coming and delivering it at your doorstep, which was the way it was done since, say, 1965 when old age pensions were introduced in Tamil Nadu. So there are certainly convenience issues which have still not been resolved in terms of the last mile connectivity of, and that's one reason, and the review of the JAM idea, I think that is one area which certainly needs to be addressed. How is the outreach part of it? Technology represents an opportunity, and some things can be done better with technology. So it goes in some senses hand in hand with what needs to be done in terms of the outreach part. Because ultimately when you do financial inclusion, the transactions need to be easier. people have to be able to sort of with greater convenience use the money which is to their credit. So whether through a mobile payment system or whether through a micro ATM that you're able to draw cash and you're able to do it on a decentralized basis and out there, subject to all the other regulatory concerns, subject to safety concerns, privacy concerns, security concerns, if you're able to do it, there's no harm in doing it. And again, the adoption of that doesn't need to be obligatory or compulsory. If it's optional and it is found to be convenient and found to be cost effective by the individual resorting to it, it'll happen. How loans are appraised and what is paid out as a loan, and that's where I think seriously the problem really starts. The behavior of loan officers, and I think it's actually a serious concern, whether it is a small loan or a big loan. We lend against face value, or we lend against knowing somebody or the soundness of the person. And the willingness to lend either to a specific project that an individual has or the credit record that an individual has not yet been built up. And there, technology can also play a role. If you have a credit information linkage and you know that credit behavior over the years has been sound and has been good, then for individuals, you would be in a position to actually lend and periodically increase the amount of loan.
Technology can do a lot, but it in the end will not replace points along the chain where humans are going to be there. It's one thing to sort of say technology can be made to work when we have something like literacy, but I think what takes a lot of time and effort to think through is exactly what is going to be required to implement that and who's actually going to have the incentives to do it.
An agriculture credit is that a very large proportion of what we actually call agriculture credit in the Indian context is at best what can be described as jewel loans. So we have an interesting case where about 80-85% of crop loans which are given on an annual basis are given against the collateral of jewelry. Now, they're used for agricultural purposes or they may not be used for agricultural purposes. And we've also had this historical dichotomy in Tamil Nadu when farm or agriculture insurance came in. The cooperative credit network, which controls about 25% of the total agriculture credit market, had almost its entire loan portfolio insured. That's because of a state government directive, and they come partly under the state government's directives. But in the case of the commercial banks, a very small proportion of the agricultural loan were insured, because a large amount of that was actually given out as agriculture jewel loans. There was collateral, so the commercial bank was simply not interested in going through the additional hassle of putting it down for agriculture insurance. Now last year, or this last season, was the first time they introduced this new agriculture insurance program, which sort of put in all the other earlier experiments and so on. It's a significantly more attractive agriculture insurance program, but with a significantly higher premium, a lot of it subsidized by government. Most of what was done with commercial banks was not actually a loan-based insurance. They were all treated as non-loany farmers. So the link with the credit actually broke down right there. And this has consequences later in terms of other sorts of behavior, in terms of the demands for loan waivers and write-offs and so on. If the insurance amount goes directly towards a credit payoff, then it's so much easier. You wouldn't even have a demand for a loan write-off subsequently in cases of genuine crop failure. So these are the kind of issues, and these are the kind of actual field level issues which would need to be studied in greater detail and which would need to be, from a policy perspective, resolved if we have to really make that link and make both agriculture credit and agriculture insurance really reach out to where farmers need to be.
If adequate loan was provided for the agriculture purpose, would there have been a need for a loan waiver? For instance, if you look at the cost of cultivation and you look at what is the loan that is to be given for a particular crop which is decided in a district, it's very, very conservative. Now, that forces the person to go to money lender for topping up whatever is otherwise required. Second, there is no throwing into it of consumption loan into it. That is also not being, because that is being required. That is required by the person to by the farmer. So if you look at what the loan amount has to be and how that is fixed, and you are able to have a robust insurance system which is able to take care of the crop failures, and also you have got the market access related issues where the kind of commercial structures that are involved for created for the purpose of taking it for market and getting the right price paid. If all those things are there, probably loan waiver would not be kind of required.